So what if I told you that the biggest threat to your investments isn't a market crash, but your own brain? We're going to jump into the timeless wisdom of Benjamin Graham's The Intelligent Investor, a book that honestly has been the secret weapon for the world's best investors for over 70 years. Let's see how its core ideas can protect us, right here, right now.
You know, the story of market madness almost always starts with a simple, really seductive promise. Back in 1929, an executive, John Raskob, he famously said that anyone could get rich just by saving $15 a month. It's an idea that just never gets old, right? This belief that incredible wealth is just right around the corner for everybody.
And boy, did that belief hit a fever pitch during the dot-com bubble. I mean, in the late 90s, it seriously felt like anyone with a dial-up modem was on the verge of becoming a millionaire. That siren song of speculation, it was playing at full blast.
The mantra, you heard it everywhere. This time is different. All the so-called experts were insisting that the old-school metrics, things like profits and assets, they were obsolete. They were literally throwing out the rulebook, completely convinced that the internet had changed everything.
Yeah, and this just captures that whole casino vibe perfectly. You didn't need to know what the business did, who its customers were, or heck, even if it made any money. Nope. All that mattered was a catchy little ticker symbol. People weren't investing in companies. They were basically just buying lottery tickets.
And for a while, the results seemed to prove the experts right. The gains were absolutely mind-blowing. An internet company called CMGI shot up almost 940% in a single year. I mean, with returns like that, who has time to worry about the old rules, right? This wasn't investing. It was a gold rush.
But of course, this kind of madness, it's nothing new. And to prove it, let's look at how one of the most brilliant minds in all of human history got caught in the exact same trap almost 300 years earlier.
Okay, so back in 1720, Sir Isaac Newton, yeah, that Isaac Newton, invested in the hottest stock of the day, the South Sea Company. And he played it like a genius. He got in, doubled his money, and got out. Smart. But then he had to sit there and watch his friends keep getting richer and richer. The mania, the FOMO, it pulled him back in right at the very top of the market, and he was completely wiped out.
And Newton's experience just reveals the core problem. He summed it up perfectly himself. Here's a mind that could literally calculate the motions of planets, but he was powerless against the emotional chaos of a crowd. It's a timeless lesson. Market manias are fueled by human emotion, not by logic.
So how do we protect ourselves from this madness? Well, we turn to the man who built an entire philosophy out of surviving it. Benjamin Graham. He learned his lessons the hard way, after his own family was ruined in the crash of 1907, and he dedicated his entire life to creating a defense against this kind of financial chaos. So what was Graham's big solution? Well, he developed this framework, one based on timeless principles, not on risky predictions. You should think of it like an antidote to chaos, one that's designed to protect you not just from the market, but from your own worst impulses.
And it all starts with this one powerful definition. This is like a filter for almost every hot tip you're ever going to hear. For Graham, a real investment has to pass 3 simple tests. First, did you do a thorough analysis? Second, does it promise safety for your principal, your original money? And third, does it offer an adequate return, not necessarily a spectacular one? If something fails even one of these tests, it's not an investment, it's just a gamble.
Graham's analogy for this is just perfect. An investor, as you see here, buys a stock like they buy groceries. They figure out the real value, and then they try to buy it for less. That gap, that difference between the real value and the price you pay, that's Graham's secret weapon, the margin of safety. The speculator, they buy stocks like perfume, totally dazzled by the fancy bottle and the story, with no idea what it's actually worth inside. And to make this whole idea really stick, Graham created one of the most powerful allegories in all of finance, your imaginary business partner, the eternally moody Mr. Market.
So imagine you have a business partner, but as it says here, he is completely manic depressive. Some days he's totally euphoric, offering to buy your shares from you at insane prices. On other days, he's in a full-blown panic, desperate to sell you his shares for pennies on the dollar. The real genius is in those last 2 points. You are completely free to just ignore him. In fact, you have to. You must never let his mood dictate what you do. His bipolar nature is your opportunity, not your guide.
And that leads us to Graham's final and maybe most profound piece of wisdom. Because the greatest risk in investing isn't a bad market or a weak economy. No, it's something much, much closer to home.
It's you. It's us.
Our brains are basically hardwired for financial self-sabotage. Studies have actually shown that the sting of a financial loss is more than twice as powerful as the pleasure we get from an equal gain. That fear makes us sell at the bottom, just like euphoria makes us buy at the top. We literally become our own worst enemy.
So, this brings us to the final critical question. The market is bipolar. Are you? We know Mr. Market is going to swing from euphoria to despair. That's a given. The only thing that truly matters is whether you let his emotions become your emotions. If you can stay rational, if you can treat his panic as your opportunity and his greed as your warning sign, you will master the game. And that right there is the timeless genius of the intelligent investor.